And welcome to AFM 451. The goal of this video is to introduce internal controls, explain what they really mean in practical terms, and ground the concept in real-world examples before we start building more technical depth in later discussions. Let's get started. Internal control is not a single policy or a compliance document. It is a coordinated set of ongoing processes embedded in daily operations. These processes are designed and carried out by people across the organization, management essentially, to provide reasonable assurance that the key objectives are achieved. These objectives could be reliable financial reporting, efficient and effective operations, of course, as well as compliance with regulatory laws and requirements. Consider a grocery store. When inventory arrives, staff compare the shipment to the purchase order and supplier invoice before accepting it. This reduces the risk of paying for goods that are not received or for receiving unauthorized products. When items are scanned at the checkout, prices are automatically pulled from a central database or a repository. This reduces the risk of pricing errors and inconsistent revenue recognition. Cash drawers are reconciled at the end of each shift to the system-generated sales report. Differences are investigated promptly, reducing the risk of theft of cash or recording mistakes. Managers review daily exception reports that flag unusual refunds, voids, or price overrides. This helps detect irregular patterns that could signal misuse or system breakdown. Access to accounting and inventory records is restricted through unique user passwords, IDs and passwords. Only authorized personnel can modify the vendor records or adjust inventory balances, reducing the risk of unauthorized transactions. Periodic inventory counts are performed and compared to system records. Discrepancies are then analyzed to address the risk of shrinkage, spoilage, valuation, obsolescence, theft, or data inaccuracies. The grocery store may perform specific inventory count and compare them to the system records and investigate the difference to address the risk of inventory loss, spoilage, record errors, etc. Vendor master files may be periodically reviewed to ensure no duplicate or fictitious vendors exist, addressing the risk of fraudulent payments. Each of these examples is a part of a broader controls framework or set of processes. Each addresses a specific underlying risk. Internal control is therefore best understood as a network of coordinated activities that reduce the likelihood or impact of undesirable events, risks. Now, let's consider several key themes. First, the cost-benefit logic is central. Controls consume time, resources, and money. So organizations must design controls that are proportionate to the risks they face. A small grocery store will not implement the same level of system automation as a Walmart because the marginal benefit may not justify the marginal cost. Effective control designs require balancing risk exposure with operational practicality. Second, human error contributes to control system limitations. Employees may misunderstand procedures, overlook steps, or make judgment errors despite the best intentions. Even automated systems depend on correct configuration and accurate data inputs, both of which are vulnerable to mistakes, human error. Internal control provides reasonable assurance, not absolute assurance, largely because of people are involved. Next, collusion can bypass even the well-designed control. If two or more people coordinate their actions, they can override segregation of duties and manipulate documentation. For example, a cashier and a supervisor working together could process unauthorized refunds that appear legitimate in the system. No control structure can completely eliminate this risk. It can only reduce the likelihood. Control failures do not always indicate fraud though. A breakdown may result from inadequate training, system upgrades, staffing shortages, or evolving business processes and needs. Jumping immediately to conclusion about misconduct can distort judgment and damage organizational culture. Effective evaluation requires distinguishing between intentional wrongdoing and operational weaknesses. Auditors evaluate controls based on organizational risk. A control is critical in one environment, but maybe less so in another, depending on the transaction volume, complexity, and of course, susceptibility to misstatements. The assessment is always risk-driven, not checklist-driven. Controls are examined to determine how well they mitigate specific financial reporting and operational risks. And lastly, regular monitoring ensures that the controls remain effective over time. Business models may evolve, personnel may change, systems may be updated, all of which can weaken previously strong controls. Ongoing oversight, periodic reviews, performance metrics, etc. help identify deterioration before it results into material consequences for the company. Internal control, therefore, is dynamic and must adapt on an ongoing basis to organizational changes. In the upcoming videos, we will examine the roles and responsibilities, the classification, and more importantly, how to respond to control failures. For now, the key takeaway is that internal controls are structured processes designed to manage risks in a practical, cost-conscious way. Thanks for following along. Take care, stay safe, and bye for now.